This is a very important video. In this video, I want to help you understand the EPS of a company. How do you analyze the EPS of a company? It's not just understanding the definition. We have to understand the growth rate, the annual growth rate, the quarterly growth rate, the stability of the EPS, the growth in the EPS over 3 to 5 years, things like that. Okay. So, what are the things that you should look for when it comes to earnings per share of a company? So, let's try to understand this. So, this is Dixon Technologies. As you can see, number one, you look at the latest quarterly EPS growth. Now, this number, it's basically comparing the September quarter earnings with the same quarter last year. So, September 2023 versus September 2024. That's the growth that you see here. Now, William O'Neill and Company, people who created Market Smith and Investors Business Daily, they have done a lot of research on this, and they have around 125 years worth of stock market data. And they found that between 1910 and 1950, the best performing stocks, the stocks which gave triple digit, 4 digit returns, the multi baggers, the best performing stocks, they had this number between 40% and 500%. So the best stocks were showing 40% to 500% return in their latest reported quarter. They did the same analysis from 1952 to 2001, and they found out that the best performing, the leading stocks, the stocks which were multi baggers, the stocks which gave triple digit, 4 digit returns in percentage terms, this number was on an average 70%. Okay. The best were in triple digit returns. So basically, this number, if you see for the best leading stocks, the growth stocks, it is beyond 40%. In most cases, it is beyond 70%, 70%. These are two facts. Okay. These are not opinions. These are facts. This is data coming from history of 125 years of stock market data. So we are looking at data. We are not looking at opinions of someone. In the book written by William O'Neill, How to Make Money in Stocks, he also says that if you want to improve your stock selection process, this number you should keep it at minimum 18 to 20%. So if you keep in your filter, if you keep this number as 18%, the latest reported quarter, minimum 18%, that will significantly improve the quality of stocks that you have on your radar, at least before you start looking at the chart. So these are the three things I wanted to discuss with you. From 1910 to 1950, the minimum latest reported quarter EPS growth was 40%. From 1952 to 2001, this number was on an average 70%. For those stocks where this growth rate was less than 70%, in the very next quarter, their reported earnings was on an average 90%, 90%. All of these statements, all of these data are given in William O'Neill's book, How to Make Money in Stocks. So please read that book, extremely important. So these are the three facts that I have told you. The number third one is keep this at minimum 18%. This will significantly improve your stock selection process. This is one. Second thing which he talks about in the book is look for accelerating earnings growth, EPS growth. So see 20%, 107%, 261%. This is called accelerating EPS growth in the latest reported, at least 2 quarters latest reported. He talks about 2 to 3 quarters of accelerating EPS growth. If I show you another stock, let's say CAMS. So if you notice, see, 20%, 38. See, from here it goes 70%, 20%, 38%, 41%, 44%. Okay. This is called accelerating EPS growth. This is what you want to see. You don't want to see declining EPS growth, even if the EPS growth is high. So let's say PB FinTech. You see 700%, 615%, 349%. So from 700%, it has gone down to 350%. So it is decelerating. It is not accelerating. We want accelerating earnings growth. Okay. In the latest reported 2 or 3 quarters. This is another important point. Next, you look at EPS. There is EPS number here. Okay. Have a look at this EPS number. Minus 91,000, minus 4,000, minus 2,000, minus 20, minus 10, and now it has turned profitable. So in the past, how many years? See, 1, 2, 3, 4, 5, 6, 7. Out of 7 years, 6 years the company has been reporting a negative EPS number. Okay. Negative EPS number means there is no profit in the company. Whereas if you contrast this with Dixon, okay, have a look at this. Let's look at past 6 years. 2018, right? 9, 10, 11, 21, 27, 32, 42, 62. Do you see the consistency in the growth of the EPS? Now, you might say, Rohit, Dixon is 261% latest quarter growth, and PB FinTech is 349%. So tell me which company is better. PB FinTech is 350% growth. Dixon is 260% growth. So you might say, well, PB FinTech is a better company. But wait, look at the annual EPS. 6 out of 7 years, it's negative EPS. Okay, but in Dixon, all 6 out of 6 years have been profitable, plus they are growing. Okay, so the important point to look for is not just quarterly growth, also annual growth. So in the book, specifically what it's written is latest 3 years, there should be at least some positive growth in the company. So latest 3 years, if you see 32, 42, 62. So the earnings have grown from 27 to 32. That's a growth. From 32 to 42, that's another growth. From 42 to 62, that's another growth. Okay. So last 3 years, latest 3 years, the EPS has been growing annually. Now compare this with something like Divi's. Okay. Have a look at this number. So last 3 years, so 2022, 23, 24. So from 21 to 22, it has increased. There is growth. But from 22 to 23, it has decreased, right? From 111, it has gone to 68 rupees. Now from 23 to 24, it has decreased further. It has gone to 60. So 2 years of decelerating growth. Okay. You might say that, okay, Rohit, there is double digit growth in quarterly earnings. Okay. You might also say, Rohit, there is 3 consecutive quarters of accelerating sales. Okay. But accelerating quarterly sales and accelerating EPS growth should be combined with growth in annual numbers as well. You see, this stock is showing growth on a quarterly basis. Okay. But what about annual? The latest 2 years in 2023, the EPS actually declined. 2024, the EPS declined even more. Okay. Now you might say, Rohit, this is recovering, but no. Last 2 years, it has been declining. The best performing stocks will show accelerating growth, whether it is quarterly, whether it is annually, doesn't matter. Moreover, he also talks about the percentage growth, not just the accelerating or growth or positive growth. He also talks about percentage growth. He says that this percentage growth should be 25% for the best performing stocks. The EPS is growing annually by 25%. Okay. And one study was done where he looked at the best stocks, the leading stocks in the stock market. He found out that the annual EPS growth on an average, the annual EPS growth for the best leading stocks was minimum 36%. Okay. You can read, by the way, you can read all of this in the book. It's not my opinion. It's just data taken from the 1800s to about late 20, early 21st century. So 125 years of stock market data is giving us this information. So if we simply take that data and apply it in our analysis process, where we are looking at earnings, that will significantly improve our stock selection process. See, just because it is forming a base doesn't mean that you buy. You have to look at what's happening with the EPS of the company as well if you want to take positional trades. If you are taking swing trades, then fundamentals do not matter as much. In swing trade, you look for stocks with very high relative strength, like relative strength of 85, 90, where there is good momentum in the stock. So there is a tailwind. Even though the fundamentals are not there, you still have a tailwind behind you. Okay. Next. So you looked at quarterly, you looked at annually. Please watch this video twice, thrice, just to understand the numbers, the percentages that I am discussing. Please take notes here. This is extremely important. I am only talking earnings. I am not even discussing sales. Okay. That is another factor we have to consider, but at least let me keep the focus on earnings here. Okay. So EPS will show up here. EPS will show up here. EPS will again show up here. So what does that tell you about Market Smith and William O'Neill's investment philosophy? The most crucial factor when it comes to stock price growth is the growth in the EPS of the company. There is a difference between earnings of a company and EPS of a company. The earnings of a company could grow 55% in 1 year, but the EPS in the same year could grow 0% if the company issues new shares. Let me repeat that statement so that you can digest it. Okay. The earnings of a company could grow 55% in 1 year, but in the same year, if the company has issued shares to raise capital, in the same year, when the earnings have grown 55%, the EPS could have grown 0%. Okay, so it's the EPS growth that matters, not the income growth, okay, or the earnings growth. So that's why EPS is showing up here, EPS is showing up here, EPS will again show up here. So what are these two numbers? EPS growth rate and earnings stability. So the EPS growth rate basically represents the annual growth rate of the company. This is what I have understood. So the Market Smith or William O'Neill and Company, they are looking at the growth of the EPS in the most recent quarters. They are looking at growth of EPS in the last 3 to 5 years. So they are looking at annual growth. They are looking at quarterly growth. And this number represents annual growth past 3 to 5 years. I don't think they are looking at uh, growth beyond 5 years or later than 5 years. 3 to 5 years of data they are looking at. And quarters, I think they are looking at the recent 10 to 15 quarters. So that is how they arrive at this number. I do not know the exact mathematical calculation, but I can tell you the higher this number, the better, because it shows the average annual growth rate of a company. And as we discussed earlier, for the best performing leading stocks of the past, this number has been minimum 36% annual growth. Okay, those are the stocks that are the most that have been the most powerful stocks of the past, stocks which have given hundreds of percents of return, stocks which have given thousands of percents of return. These are super multi-bagger stocks. These are the characteristics that they have shown before they began their price advance. This is very important. These are the characteristics that they show before they begin their price advance. Okay. So you see EPS growth rate is 8% for Divi's. Let's check that for Dixon. It is 34%. So can you see immediately you can see the difference between two stocks. So if I compare Dixon with Divi's, this number is 34% for Dixon, 8% for Divi's. So which stock is better? Of course, Dixon is better. This number, you have accelerating quarterly growth. You have triple digit quarterly growth in EPS, whereas Divis has double digit quarterly growth and not accelerating. You see hiccups in Divis numbers. Sometimes it is going up, sometimes it is going down. But here it is going down for consecutively 3 quarters. So which stock is better, Dixon or Divis? Moreover, if you look at Divis, the last 2 years EPS has declined, but here last 6 7 years the EPS has been consistently growing. Which stock is better, Dixon or Divis? So see, I'm comparing two stocks from different industry groups, but this kind of comparison will help you understand where you should focus your research on. Okay, this is extremely important. If you understand how to read the EPS of a company, that will allow you to compare hundreds of stocks with each other. You will know which stock is exhibiting the best characteristics when it comes to the EPS analysis. So, this video is mainly about EPS, EPS, EPS because EPS is the most crucial factor in determining whether the stock price will go up or not. Okay. Now let's come to earnings stability. What is earnings stability? First, you need to understand that the lower this number, the better it is. Okay. Just understand that the lower the number, the better it is. Unlike these numbers, where the higher the number, the better it is. So this basically talks about earnings stability. And if this number is less than 25, preferably less than 20, it is very good. Okay. It shows that the earnings are not only there, but the earnings are stable. So where does this number come from? If you look at this number for Divis, I'm just randomly taking two stocks just to help you understand. So see, this stability is 25 and growth rate is 8%. But for Dixon, this is 34 and this is 8. So the exactly reverse. So Dixon has a better EPS growth rate than Divis, and Dixon has a better earnings stability than Divis. Okay. As I told you, 25 is always higher than 8, right? Dixon has 8 earnings stability. So Dixon not only has better average annual growth rate in its EPS, it also has better stability compared to Dixon. Sorry, compared to Divis. Okay. So not only are we looking at the growth rate, we are also looking at the consistency or the stability of the growth rate. Now, for those of you who want to understand how this number comes, let me tell you how that number is arrived by MarketSmith. I will not give you the formula, I will give you the general guideline. And by the way, all of what I am discussing is already described in William O'Neill's book. So this is not some new pioneering knowledge that I'm giving you. It's already there in the public domain. All you have to do is just pick up the book and start reading and start understanding these numbers. Okay. So where does this number come from? Basically, what they do is they take the EPS of each quarter. Okay, every quarter you will have a EPS number, as you can see here, and you can actually plot this EPS number on a graph, just like you have price drawn on a graph here. Okay, you can draw the EPS as well. Imagine removing this price and just drawing the EPS. So if I click on the weekly, you can see that line. This is the orange line. Okay. See, this is the orange line. That's the EPS line. They have already plotted it. So when you plot this orange line, okay, you can also plot a trend line. Just like for a price, there is a moving average. For a EPS, you can draw a growth trend line. Now, we want to see whenever the earnings or EPS is reported every quarter, how far is that EPS number away from that trend line? If it fluctuates too much from the trend line, that means the EPS is not stable. But on the other hand, if it doesn't fluctuate too much from the trend line, if the trend line is very smooth, okay, just like a moving average for a stock, if the trend line is smooth, then we can say that the deviation from the trend line is not much. So this number is actually represents the deviation of the reported EPS with the trend line. Okay, trend line expects a particular EPS, and that expected EPS is compared to the actual reported EPS. So the more it deviates, the more this number is going to be. So as we can see, the deviation was 25. Now I don't know whether this is percentage or what. I just know that if this number is higher, then the deviation is more. Okay. So the lesser this number, the better. So the deviation of Dewey's laboratory from its trend line is more than the deviation of Dixon from its trend line. That is what this number represents. Let me repeat that statement so that it gets concrete in your mind. So the deviation of the EPS of Dewey's from its EPS trend line is more than the deviation of Dixon's EPS, reported EPS, compared to the Dixon's EPS trend line. Okay. So basically, the lower the number, the better it is. Just remember that. So this is what we need to look for. We need to look for accelerating EPS growth in each of the past 3 quarters. We have to look for accelerating EPS growth annually. So basically look at quarterly EPS growth and annual EPS growth. Also look at the growth rate, overall annual average annual growth rate. The higher the number, the better. Also look at the stability of the earnings. The lower the deviation from the EPS trend line, the better it is. So as long as this number is below 25, preferably less than 20, the better the stability of the EPS growth of the company. So these are the 3 things that I wanted to discuss with you. In this video, I decided to go deep into EPS because that's the most crucial factor. It's not the P ratio, it's not the moving averages, it's not the volume, it's the EPS that makes all the difference to the stock. Okay. And notice the EPS starts to fall here. So till this point, the EPS was growing. This is the quarter when the EPS actually fell. And you notice the price is a leading indicator. The EPS started to fall in October 2022, but the price began to fall in October 2021. So you see, the price begins to fall before the EPS begins to fall. Okay. So first you follow the price, then you follow the EPS. Okay. Of course, EPS is an indicator. Good EPS growth will lead to great price movement. But when it comes to spotting the declines, you better follow the price than you follow the EPS. Okay. So see, EPS starts to fall here. But just 1 year before that, the price had already started falling. The opposite is also true. See, it kept on falling till here. This is the point where it started rising. Okay, this was January 2024. But much before that, in March 2023, so 9 months before the EPS actually grew, the price already started rising. Okay, so before EPS starts to fall, the price starts to fall. And before EPS starts to go up, the price starts to go up, which means the price is a much better indicator than the EPS itself. So they say price is everything in the market. This is the reason why they say price is everything in the market. Follow the price movement. EPS is, of course, is an important factor, but price is a much more important factor than the EPS itself. So I hope this video has added value to your trading journey. Please take notes. And if I have missed out certain points, these points will be covered in the book, How to Make Money in Stocks, written by William O'Neill. Please buy that book. It's a red color book. Fantastic book. Read the chapters on current earnings and annual earnings. That's it. That if you just read those 2 chapters, take notes, watch this video, you will understand what I'm trying to convey. Okay. So thank you so much for your time. Please do not forget to download the swing trading checklist, the positional trading checklist, and the stock categorization checklist. Also look at some of my premium educational resources like my video course, training, coaching, so that your learning if you want to speed up your learning, you have to invest in your training. So please have a look at that as well and continue to spend around 15 to 20 minutes on my YouTube channel every single day. Okay. Recently, I have started uh, publishing videos every weekday. I have decided that I will take the weekends off because I need rest as well. So I want to reduce the number of videos that I publish, but I want to increase the quality of the videos that I publish. So there is power in slowing down in life. Okay. So I hope you appreciate that. Thank you so much. Thank you so much for your time. Thank you so much for your support. As usual, please don't forget to like, comment, and share this video. Support this channel. Have a fantastic day today.